Okay, so today let's try to take a deep dive into something pretty different. It's called low expectations investing.
Uh-huh.
And, it's a strategy that might seem counterintuitive at first glance, but
Right.
you just might find it changes the way you approach the market if you stick with us.
Yeah, I think a lot of people have maybe heard the saying buy low, sell high.
Yeah,
And this really kind of takes buy low to a whole new level.
it does. Yeah, exactly. So we've got this great interview with Dan Ha from Crony Asset Management. He was featured on Global Money Talk. And I have to say,
Yeah.
his insights into low expectation investing were really pretty eye-opening for me.
Yeah, and Dan's not out there just chasing, the hottest stock, whatever's really popular.
Uh-huh.
He's looking for solid companies that maybe the market's overlooked.
So instead of just jumping on the bandwagon, he's really looking for the diamonds in the rough, it sounds like.
Yeah, precisely.
Yeah.
And since these companies aren't getting a lot of attention, their stock prices are often a lot lower than they should be,
Right.
creating a really good entry point.
So how does he actually find these hidden gems?
Yeah.
Is it really as simple as looking for stocks with low price-to-earnings ratios?
Well, it's a little more than that.
Okay.
A low PE ratio alone doesn't really give you the whole picture.
Right.
And he uses this thing called relative valuation.
Relative valuation, tell me more.
Yeah, so it's about looking at a company's PE ratio and in context, right?
Uh-huh.
So you compare the current PE to its historical average,
Uh-huh.
but also to the PEs of its industry peers.
Oh, okay.
So a seemingly low PE might actually be pretty high if it's above those norms or higher than its competitors.
So it's really all about understanding where a company stands relative to, its own history and
Yeah.
the competitive landscape. But couldn't relying so much on that past data kind of blind us to a company that's really transformed their business, and is ready for big growth?
Yeah, I think that's a really good point.
Yeah.
You got to consider the qualitative factors.
Mm-hmm.
Dan cautions about starting with valuation alone,
Okay.
because it's so easy to see a low price
Right.
and overlook maybe some red flags,
Yeah, it's kind of like going to the discount store and being so excited about the price that you end up buying a bunch of junk
Totally. Yeah.
that falls apart.
You can fall into this confirmation bias trap where you just start
Right.
looking for reasons to like it because the price is low,
Yeah.
even though
Absolutely.
it might, not be a good company.
So how do you avoid that? What's the antidote to confirmation bias?
I think Dan says kind of flip the script, right?
Okay.
So instead of starting with just valuation, begin with a list of companies you really like
Yeah.
that are high quality companies
Okay.
with good management, consistent earnings,
Right.
innovation.
So start with companies that you'd be happy to own even if they weren't on sale.
Yeah, exactly.
Yeah, okay, but then how do you even define high quality, right? I mean, the market changes so quickly. What are his criteria for that?
Yeah, so they look at things like return on invested capital.
Okay.
That tells you how well they're using their money to make profits.
Right.
They look at management, their track record, their vision.
Okay, so it's not just about the numbers. It's really evaluating the leadership.
And their ability to kind of make it through the market. Yeah.
Yeah, so then this is where the low expectations piece comes in. He's
Yeah.
waiting for that entry point, right?
Exactly.
Like when a company is temporarily out of favor,
Yeah.
but the business is still strong.
Yep.
Okay, so it's kind of like having a shopping list of your favorite stocks
Yeah.
and just waiting for them to go on sale. But how do you identify those moments, right?
Right.
When is a company just, out of favor temporarily versus actually having problems?
Right. That's the key. And Dan gives a really good example of this
Okay.
from after the 2020 election.
Oh, yeah.
Big,
The 2020 election was a roller coaster.
huge for the markets. So while a lot of sectors went way up after the election,
Mm-hmm.
Dan noticed that healthcare and tech hardware companies actually went down.
Oh, wow.
Even
So
though-
they went down even though the market went up.
Yeah, they were doing well, but there was all this uncertainty about what would happen with policies and
right.
regulations.
Yeah.
And that spooked some investors
Okay.
and drove the prices down.
So while everyone else was chasing that rally,
Yeah.
Dan saw this opportunity.
Yep. He's thinking differently.
Yeah, that like a real contrarian mindset, I feel like.
Totally.
And speaking of that, he says that this whole approach requires a lot of patience, right?
Oh, yeah, for sure.
It's not about those quick gains. It's
Right.
about letting investments mature.
Yeah.
Which is hard in today's market, right? I mean, we're always getting bombarded with information and, it feels like you're supposed to react to everything.
Right. It's like you're trying to meditate with a puppy in your lap,
Oh, that's a great analogy.
So many distractions.
Yeah.
It's hard to stay focused. He says it's a constant battle,
Yeah.
even for him.
But you think having a process can help?
Definitely.
Okay, so it's not just about willpower. There
Uh-huh.
are actual things you can do to stay focused for the long term.
Or sure. So like one thing they do at Dan's firm is they have a grace period
Okay.
before acting on big price moves.
So if a stock goes way up or way down,
Yeah. So let's say,
Yeah.
jumps or drops a lot.
they don't immediately jump in.
They don't do
Hey,
anything.
knee-jerk reaction.
No knee-jerk. They just wait a few days.
Okay.
And they analyze the situation,
Uh-huh.
see if it's a real opportunity or just noise.
Oh, interesting. So it's like a cooling off period
Yeah, just detached from the emotional roller coaster.
to make a rational decision.
Exactly.
Yeah, I can see how that would be really valuable.
Mhm.
Like it's a safety net
Yeah.
to prevent you from making an emotional decision
For sure.
that might derail everything.
It forces them to say, is this price move justified?
Yeah. Yeah.
Like, is there a reason?
Based on fundamentals, yeah.
Yeah, is it real or not?
I like that. Okay, so then,
So then he talks about this idea of factors.
yeah, you mentioned that earlier,
Yeah.
like characteristics that influence performance, right?
Yeah, think of them like filters to find the right investments.
Right.
So, size, valuation, profitability,
So instead of looking at every company,
Yeah.
you narrow it down
To
that
take it.
companies that have
that you
the
think
characteristics you're looking for.
will be successful. Yeah.
Yeah.
And there's research that shows this works.
Yeah.
So like companies with high return on invested capital,
Right.
they tend to do better over time.
Because if they're using their money well, they're probably going to...
They're doing something, right?
Yeah, they're doing something right.
Yeah.
But it can't be as simple as just picking a factors, right?
Right. And he warns against just chasing whatever's hot right now.
Okay.
The key is to find factors that you really believe in,
Right.
that fit with your goals, and then stick with them,
Okay. Even when they're not doing well.
especially when they're not doing well.
Oh, so there's that patience again.
Have patience.
I'm sensing a theme here.
It's hard.
He also talked about how corporate culture is important, right?
Yeah.
How do they evaluate something like that?
It's tough, but they look at like
Yeah.
employee satisfaction, leadership, transparency, ethical practices.
So it's more than just the numbers.
Yeah, they want to understand, like the
Mm.
people behind the numbers.
Yeah, I like that. Okay.
Yeah.
But even with all this, can't something unexpected happen
Oh, yeah,
and
definitely.
derail everything?
For sure.
And that's where risk management comes in.
Risk management, exactly. And Dan talks a lot about diversification.
Okay.
So you don't want to put all your eggs in one basket, even
Right.
if you think you found all these amazing companies.
Right.
You want a good mix of assets.
Okay.
So like a team, right?
Yeah.
Some players are good at different things.
Yeah, a well-rounded team.
Exactly.
Yeah.
Some are focused on growth, some on stability.
And some are your low expectations players.
Yeah, exactly.
Yeah.
And then within those categories, you want to diversify too.
Right.
By industry, geography, all these things.
Oh, so it's not about ignoring high growth. It's about balancing the two.
Exactly. It's about making your portfolio resilient
Okay.
so it can weather the storms.
So low expectations is kind of like that steady Eddie player, right? That gets you through.
Takes those base hits.
Yeah.
You know?
Okay, so starting to see how this all fits together now.
Yeah.
Started those high-quality companies, wait for the right price,
Mm-hmm.
focus on the factors, be patient, diversify.
Diversify, yeah.
That's a whole approach.
It is. And Dan says it's about finding what works for you,
Okay,
not just copying him.
right.
Understanding your goals, your risk tolerance, all that.
Your own personal situation.
Yeah.
Yeah, so be intentional with your investments.
Be intentional, yeah.
Do the research,
Mhm.
don't follow the herd,
Don't be afraid to be different.
and then control your emotions.
Yeah, that FOMO, that's a killer.
Yeah, fear of missing out.
Fear of missing out, everybody's got it.
Yeah,
But you have to have a system,
okay.
a set of principles to guide you.
Like a pre-flight checklist.
Yeah, exactly.
When you're not making
emotional decisions.
emotional decisions. Yeah.
Hmm.
I like that. And you said earlier that his firm avoids using too much leverage,
Right. Leverage can be dangerous.
right? That's borrowing money to amplify returns.
Right. It's risky.
Yeah.
But he says it can really backfire.
Because it magnifies losses too.
Yeah. And it can force you to sell at the worst time.
Yeah, when you're down.
Exactly. You have to sell to cover your debt,
Yeah.
even if you believe in the company.
You lose your staying power.
Yeah, you lose that ability to wait it out
So it can really limit your patience, that leverage.
big time.
And I remember he said they also avoid companies with too much debt.
Right. They want companies with strong financials.
So it's not just about your own leverage. It's
No.
about the leverage of the companies you invest in.
Yeah, you want companies that can handle tough times,
Right.
without being crushed by debt.
Yeah, so be financially responsible.
Be responsible.
Yeah, both in your own investing and in choosing companies
For sure.
that are also financially responsible.
Yeah, I mean, it goes back to that independent thinking thing.
Yeah, you said they really do their own research.
They don't just blindly follow the analysts.
Right. So they use those reports as a starting point.
Yeah, as a starting point.
But they really dig deep.
They do the work.
Into the financials, the management. Yeah.
Yeah, they're looking for evidence. Not just opinions.
So the critical thinker.
They think for themselves.
I like that.
Yeah, it's not just about having knowledge. It's about using it.
Yeah.
And filtering out the noise.
You need those analytical skills, but also the emotional intelligence to deal with the market.
It's a balance.
Yeah. Okay. And then he said something really interesting.
What's that?
He said that public market returns don't have to be worse than private equity returns.
Yeah, I know.
Now, that was really surprising to me.
Yeah, a lot of people think private equity is this,
exclusive club.
Yeah, this exclusive club.
With amazing returns.
With these crazy returns.
But he thinks that anyone can do it.
He thinks anyone can do it.
With the right mindset.
With the right mindset.
So it's not about having access to special deals. It's about having
discipline,
long-term thinking.
Long-term and tuning out the noise.
Yeah, and those are things anyone can learn.
Okay.
You don't have to be an expert to do that.
Wow, this is really making me think about how I invest.
It's easy to get caught up in the hype.
Yeah.
But the real success comes from thinking differently.
Patience, discipline, being a contrarian.
It's about focusing on the signal.
Yeah, and that brings us to the last part of our deep dive.
Okay.
Where we're going to explore what all this means for you.
Cool.
And how you can use these insights.
Sounds good.
On your own journey.
I'm ready.
All right, so stay tuned for that. It really is like trying to meditate.
Yeah.
In a room full of puppies.
Right.
Your brain just wants to...
So many distractions.
Oh, so many distractions.
Yeah.
Okay, so Dan acknowledges that it's a battle.
Oh, yeah.
Even for experienced people.
But he thinks that having a process in place can help.
Yeah, definitely.
So that's not just about, white-knuckling it. Things you can actually do.
For sure.
Okay, look, what kind of things?
So one thing his firm does is they have this built-in grace period.
Okay.
Before they do anything when prices move.
Okay, so if a stock in their portfolio jumps or drops.
Yeah, so let's say it moves a lot,
Yeah.
Really significantly.
They don't immediately buy or sell.
They don't do anything.
They just wait.
They wait.
Yeah.
Usually a few days.
Okay.
And they analyze.
Uh-huh.
And say, is this real?
Is this a real opportunity? Or is it just
Just the market being crazy?
Market noise, yeah.
Yeah, exactly.
Okay, so it's almost like taking a step back from that emotional roller coaster.
Totally.
Yeah, detaching and making a rational decision.
Exactly. It helps avoid those impulsive moves.
That you might regret later.
That you always regret later.
Yeah. Oh, yeah.
Yeah, with 2 days later, you're like, why did I do that?
What was I thinking?
Yeah, okay, so... And it forces you to think. Okay, is this move justified?
Yeah. Based on the fundamentals of the business.
Is something real happening here, or is it just, just random?
I like that. I like that a lot. Okay, so then he talked about this other concept of factors in investing.
Factors, yeah.
Yeah, and I think you had mentioned that a little bit earlier, but these are like specific characteristics that can influence a stock's performance, right?
Yeah, think of them like filters.
Okay.
To help you narrow it down, your investment search. So things like, the size of the company, the valuation, the profitability.
How much money they're making.
Yeah, the momentum.
So instead of trying to analyze every single company out there,
right, too much.
You can focus in on ones that meet certain criteria.
That have the characteristics you want.
Okay.
And there's actually a lot of research on this.
Yeah.
Companies with a high return on invested capital,
right,
they tend to do better over time.
Okay, because they're using their money.
They're doing something, right?
Right.
Yeah.
But it's probably not as simple as just picking a few factors, right?
No, you can't just pick whatever's trendy.
You go with that, yeah.
Yeah, Dan says you got to find factors that you really believe in.
Okay, so you have to have your own philosophy, your own set of beliefs that fit your goals. Yeah, and stick with them.
Yeah, even when they're not doing well.
Oh, there's that patience again.
That patience. It's always there.
Always
working in the shadows.
I'm definitely noticing a theme. I'm curious, he talked about how a company's culture is also a factor.
Yes.
And that's something that's kind of hard to quantify.
Right, it's hard to measure.
Right. How do they even evaluate that?
So they look at things like employee satisfaction.
Okay.
How transparent the leadership is.
Right.
Ethical practices, the mission of the company.
So it's kind of like that qualitative analysis.
Yeah, they try to...
Mixed with the quantitative...
Get a feel for the people.
Yeah, the humans behind the numbers.
Behind the scenes, yeah.
Yeah, okay, I like that.
Yeah.
But even if you identify all these strong factors...
Right.
And you have all the patience in the world... What about those unforeseen events, right?
Yeah, stuff happens.
Stuff happens, yeah.
All the time.
And that's where risk management comes in.
Risk management, exactly.
Right. And Dan talks a lot about diversification.
Diversification is key.
Don't put all your eggs in one basket.
Don't put all your eggs in one basket, no matter how much you love that basket.
Yeah, even if it's full of those undervalued companies.
Exactly.
You want a mix of assets.
You want a mix, yeah.
With different roles to play.
Different strengths.
Like a well-balanced team.
Yeah, like building a team.
Yeah.
You want some players who are going to hit home runs.
Right.
You know, some who are going to be consistent.
Some who are going to get you those base hits.
The base hitters, yeah, you need those.
Yeah, you need those, okay.
And remember those factors we talked about.
Yeah.
You know, you can find factors that align with both, right?
So a factor that could signal low expectations, but also high growth potential.
Exactly. So you can have a company that you think is going to grow a lot,
right?
But the market doesn't agree with you yet.
Interesting.
And that's a great opportunity.
This whole deep dive is really making me think about being a contrarian thinker, right?
Yeah, going against the grain.
Yeah.
It's tempting to just follow the crowd.
Yeah.
But, you know, sometimes the best opportunities are
where other people aren't looking?
Hiding in plain sight.
Yeah. Okay, so be patient.
Be patient.
Do your research and really have the courage to stick with your strategy.
Stick to your guns.
Yeah, even when it's not popular.
Yeah, sometimes the best thing to do is to be different.
You know, and we've been talking about Dan's approach.
Yeah.
But there's no one right way to invest, right?
Right. Everyone's different.
You have to find what works for you.
Your goals, your risk tolerance.
Yeah, your own personal situation.
Your time horizon.
And part of that is understanding your own emotions, right?
Emotions are huge.
Especially the fear of missing out.
Oh, FOMO, the dreaded FOMO.
That can really derail you.
It can really get you.
Yeah.
It's so easy to...
Yeah, if everyone's making money on something.
Yeah, you just want to jump in.
And you just feel like you're missing out.
And it feels like everyone's getting rich except you.
And it feels like it's easy.
Yeah.
But it's not.
Right.
It's never easy.
It's not easy. And Dan admits that even he feels FOMO sometimes.
Oh, yeah, everyone does. Yeah, but he says you have to have that system in place.
You have to have rules.
Yeah, like almost a pre-flight checklist.
Yeah, like a checklist, exactly.
For your investments to make sure...
To keep you grounded.
That you're not letting your emotions...
When things get crazy. Yeah, because they will get crazy.
Yeah, and you know, we've talked about the grace period.
Right. That helps.
That helps, yeah.
Oh, wow.
But his firm also avoids using too much leverage.
Right. Leverage is a dangerous tool.
Yeah, and just to remind everyone, leverage is when you borrow money.
Yeah, you're basically...
To amplify returns.
Yeah, you're using debt.
Right, but it can be really risky.
Super risky.
Because it also magnifies your losses.
Yeah, it cuts both ways.
Right.
And it can force you to sell at the worst possible time.
Oh, when you have to meet those debt obligations.
Yeah, you're like, I don't want to sell this, but I have to.
Yeah.
Because I owe money.
Right, so you lose that ability to be patient.
You lose all your patience.
And I remember he also said they avoid companies that have a lot of debt on their balance sheets.
They want companies with strong financials.
So it's not just about your own leverage.
No.
It's also about the leverage.
The leverage of the company.
Oh, the companies that you're investing in.
You want companies that can weather the storm.
Without being crippled by debt.
Exactly.
So it's all about being financially responsible.
Be responsible, yeah.
In your own approach, but also...
And in picking companies.
In the companies that you choose.
That are also responsible.
Okay, and this ties into, I think, his emphasis on independent thinking, right?
Independent thinking, yeah.
Yeah, and you were saying that they really do their own research.
They don't just, like, take the analyst reports at face value.
They don't just follow the headlines.
No, they use them as a starting point.
Okay.
But then they really dig in.
They do the work.
They do the work.
To verify or to refute?
Yeah, is this true?
What's in those reports?
You know, what's the evidence?
Okay, so they're really critical thinkers.
Critical thinkers, yeah. They're not just
passive consumers of information.
Passive consumers, yeah, they're actively...
They're engaged.
Yeah, okay, so you need those analytical skills.
You need the analysis,
but
you also need that emotional intelligence.
The emotional intelligence, yeah, to deal with the market's ups and downs.
Right, the market will test you.
Yeah, okay, and then he said this really interesting thing.
Oh, yeah, this is a good one.
About how public market returns don't have to be worse than private equity returns.
Yeah, I love this point.
And this was really surprising to me.
Yeah, a lot of people think private equity is like this special thing.
This exclusive club.
Yeah, that only the rich people can get into.
Yeah, with these amazing returns.
With these crazy returns.
That us regular folks can only dream of.
That we can only dream of, yeah. But Dan says, no, anyone can do it. Anyone can get those returns.
Yeah, if you have the right mindset.
So it's not about having access to special deals or information.
It's about the discipline.
Discipline, the patience. The long term. Yeah, and not getting swept up in all the hype.
Yeah, and those are things anyone can do.
That anyone can cultivate.
Yeah.
Okay, so you don't need to be a financial expert to get those kinds of returns.
You just got to have the right mindset.
Wow, this is really making me rethink my whole approach to investing.
It's a different way of thinking.
Yeah.
You know?
Yeah, and it's so easy to get caught up in the hype.
Oh, it's so easy.
Right.
Especially nowadays with all the
information
coming at you.
Yeah, all the time.
But the real success comes from thinking differently.
So patience, discipline, being a contrarian.
Being a contrarian, yeah.
It's about tuning out the noise.
Tuning out the noise and focusing on the signal.
I like that a lot.
Yeah.
And that brings us to the last part of our deep dive.
All right, cool.
Where we're going to explore what all this means for you.
Let's do it.
And how you can apply these insights.
Sounds good.
To your own journey.
I'm ready.
I'm really thinking about, my own portfolio after all that.
Yeah.
It's a lot, but in a good way.
It's a lot to think about.
Yeah.
But
it makes me wonder, how do you balance this whole low expectations thing?
Yeah.
With needing growth in a portfolio?
That's a great question. And I think the key is to remember that it doesn't have to mean sacrificing growth.
Okay, so you don't have to choose one or the other.
You have to choose, yeah.
You can have both.
It's about balance.
Okay.
And that's where that diversification comes in.
Right. Building that well-rounded portfolio.
Yeah, so Dan talked about having a mix of assets with different roles.
It's kind of like having a team of all-stars.
Yeah, exactly.
Different strengths and playing styles.
You want some home run hitters.
Yeah.
And you want some steady, reliable players.
And remember those factors we were talking about.
Yeah.
Maybe you can find some factors that signal low expectations.
You could find factors that align with both.
But also growth potential.
Yeah, you might have a company that you think is going to grow a lot.
Right.
But the market hasn't figured it out yet.
And that's a great opportunity.
This
whole deep dive has really highlighted the importance of being a contrarian.
Yeah.
Looking beyond the hype.
Thinking for yourself.
Doing your research.
Doing the work.
Having that conviction.
Yeah.
To stick with your strategy.
To stick with it even when it's not popular.
Even when it's not.
Even when it's hard.
Yeah.
It's
tempting to just follow the crowd, but sometimes
the best
opportunities are where other people aren't looking.
Where no one's looking.
Yeah. So be patient.
Do
the research. Have the courage to be different.
Be different. Think differently.
And remember, there's no one right way to do this.
Everyone's different.
Right. What matters is finding that strategy.
Yeah. What works for you.
That works for you.
Your goals, your
personal situation. Yeah.
Time horizon.
And part of that is understanding your own emotions.
Oh, yeah. Emotions are huge.
Right. Especially FOMO.
FOMO can really get your...
Fear of missing out.
It can really mess you up.
Yeah. And, we've talked about the grace period and avoiding leverage, but ultimately it's about having a plan.
It's about having a system.
Yeah.
Rules to follow.
A framework.
So that when things get crazy, you don't panic.
You don't make those emotional decisions.
Right, because you'll make bad decisions.
Right.
When you're emotional.
So as we wrap up,
yep.
Here's a little challenge for everyone listening.
Okay,
Think about how you're investing now.
Yeah.
Are you chasing those hot trends?
Are you following the herd?
Or are you looking for those hidden gems?
Are you thinking differently?
Think about the factors that matter to you.
What do you believe in?
Explore those different sectors and industries.
Step outside your comfort zone.
That might be a good fit for this approach.
Yeah.
And most importantly, keep learning, keep questioning, and keep that adventurous spirit alive.
Keep learning, keep growing.
Yeah. Happy investing, everyone.
Happy investing. There's a really fantastic fan